Hi everybody and welcome to the second lesson of the Macro Compass Bond Market course. In this second lesson, we are going to take what we learned from our previous first episode, the macro and the technical approach, and apply it through a deep dive of the front end of the yield curve. As we will learn, the front end of the yield curve is composed by many instruments which give different signals and different insights into what's happening in markets. So let's have a look at the front end of the yield curve together. So guys, as I just said, the front end of the bond market is really composed of many instruments, not a single one. And in order for us to have a look at what are the main, most common front end instruments, let's have a look at the US front end curves and European front end curves. You can see 4 of them that are depicted in these charts. So let's start from the US. In the US, the most commonly used front-end rates and front-end curves are the overnight index swap, OIS, the Treasury, or I should say the T-bill curve. Notice as I go from 3 months to 2 year as a tenor here for these curves, as we're literally focusing on the short end, overnight index swaps, Treasuries or short-dated T-bills, the nowadays extinct US LIBOR in orange, and short-end corporate bonds, in this case BBB rated corporate bonds. Now if you go through this curve, you can see that as we speak today, July 21st, the day of this recording, most of these curves are inverted, which basically is a signal of the market anticipating future Federal Reserve easing after the hiking cycle. But I want to draw your attention to the fact that these curves here are not all starting at the same point, and there is quite some distinction when it comes to front-end rates. So the lowest yielding curves are the OIS and the Treasury and T-bill curve. They are virtually the same, although not exactly the same, and we'll explain what is the difference between the OIS and the Treasuries or T-bills. If you add a bit of a spread on top, you would go to the good old and now extinct LIBOR curve. So the overnight index swap is basically a proxy of the future market expected Fed fund rate. We'll explain how that works. T-bills, I think it's self-explanatory. LIBOR, the extinct LIBOR would be the rate at which banks lend money unsecured to each other. As you can see, LIBOR rates are higher than Treasuries or overnight index swap rates because, as we will explain, there is a credit component here that doesn't exist in OIS or in Treasuries and T-bills, which is basically the risk that banks go belly up and the unsecured loan goes bust. BBB corporate bonds are even a bit riskier than the defunct LIBOR, definitely riskier than OIS or than Treasuries and T-bills, but they're an important front-end curve to understand because this is where a lot of players in the front end actually park their money because they get more return for a little bit of additional risk. So 4 main curves, one is extinct, OIS, Treasuries and T-bills, most important ones, and anything with a credit overlay on top, so LIBOR and corporate bonds in the US. In Europe, if you look at the front-end curves, you find a similar situation with quite different mechanics when it comes to the difference between German government bonds and the overnight index swaps for Europe. So again, as a reminder, overnight index swaps in Europe represent the market implied path ahead for European Central Bank interest rates. Risk-free, therefore, being a deposit at the domestic central bank. German government bonds yield much, much less, several basis points less than overnight index swaps. So, of course, German government bonds are considered to be the benchmark AAA safe collateral in Europe. But contrary to T-bills, which basically yield very, very close to overnight index swaps, in Europe there is a big premium between German government bonds and overnight index swaps. Both are risk-free, but German government bonds yield less. Therefore, there is a premium. We will explain why that is the case. This is the only big difference. For the rest, Euribor, which still exists actually, it's not extinct, as you can see, has a bit of a credit spread on top of overnight index swaps for the same reason as the extinct LIBOR, because this incorporates the credit risk of banks lending to each other, BBB corporate bonds an additional layer of risk premium on top due to the possibility that these corporates could default. So again, guys, there are many front-end instruments, not only one. There are also some differences between European front-end curves and US front-end curves. Let's have a better look and a better definition of all these front-end instruments. I will go back between this table with definitions and the chart before, so you can visualize and remember what are the differences and why do they matter between these front-end instruments and who are the players. Very important to understand the monetary plumbing effects. So the main point you should remember from this is that there are many front-end instruments, but not all of them represent risk-free rates. Or in particular, not all of them represent what you are mostly looking for, which is market expectation for future Fed funds or for future ECB deposit rate. Not all rates in the front end reflect only central bank expectations, but in some cases, as we will see and explain for treasuries or government bonds, also represent the scarcity or abundance of collateral. And when it comes to Euribor or to corporate bonds, they represent an additional layer of credit risk being priced in. What you are mostly interested in when you look at the front end is the OIS market, overnight index swaps. Why? Because the overnight index swaps is the purest form of risk-free interest rate. Overnight index swaps is a close proxy for market-implied future Fed funds or ECB deposit rate. Those are the most risk-free instruments and the cleanest, purest expressions of what the Fed is priced to do and what the ECB is priced to do by markets going forward. So you're really interested in the OIS curve. Now, when it comes to risk, OIS is basically risk-free. It's an overnight deposit at the domestic central bank. One of the main points we will cover here is that not all players have access to the central bank. It's mostly domestic banks and a few other selected agencies that have access to the Fed and to the ECB. So only banks mostly can use the OIS rate, can effectively deposit cash overnight at the central bank. There is a plethora of other players, pension funds, asset managers, FX reserves manager, corporate treasuries, and more. They do have the need to deploy their dollars or their euros in overnight safe instruments, but they do not have access to the Fed. They cannot deposit money at the implied rate by OIS. Therefore, they will be looking for substitutes. When your need is to have a risk-free deposit, then if you don't have access to the central bank, what you will be doing is looking at safe collateral, safe government bonds. In the US, that is treasuries. In Europe, that is German government bonds. Well, pretty much self-explanatory, treasuries or T-bills are issued by the US government. Therefore, they are considered to be risk-free. German government bonds in Europe, the story is a bit more complex. In Europe, you don't have effectively, we are just maybe starting the experiment of having European Union issued bonds, but for most of recent history, we didn't have a, let's say, bundled bond issuance, a European level, AAA rated safe bond issuance, but actually only bonds issued by single countries. So it was the most liquid and highly rated market, the German government bond, that is considered the true risk-free benchmark reference bond in Europe. That's the collateral that everybody wants when it comes to trying to achieve closest proxy to risk-free. If you cannot directly deposit in OIS, at the ECB, you will be looking for safe collateral. AAA German government bonds. Now, as we will see later, if you are again looking for risk-free, if you're a bank, you have your option to deposit at the central bank, or you can buy treasuries or German government bonds. If you are anything else than a bank, You most likely don't have access to a domestic central bank. So your risk-free deposit is not OIS, but it is treasuries or German government bonds. There is another option, which is a reverse repo. And we will explain that later, but in brief, just for you to understand, what that is a pension fund or an asset manager taking their cash, lending it away in exchange and collateralized by the very same treasury or German government bond. So it's a safe AAA collateralized loan, effectively, which is much safer than an unsecured deposit held at the bank. And the reverse repo, therefore the repo market in general, is another lever through which entities with no access to the central bank can deploy their cash safely. Why am I mentioning that? Because in the US, you can see that I mentioned here OIS or SOFR. And SOFR basically represent, and it's a blend of repo rates that go on in the United States. So basically you can have an idea of where the repo market is traded, and the repo market is used by many of these players here to try and access a risk-free rate without having access to OIS or the Federal Reserve. If we go back to the charts, we can easily see all of this depicted here. So if you're talking about the US and you are a bank like JP Morgan, your risk-free short-term instrument will be OIS. OIS reflects the deposit rate at the Federal Reserve priced by the market over time. If you're not a bank and you look for a risk-free deposit, then you will be buying T-bills. As you can see, T-bills are very closely yielding as a term structure to the overnight index swap rate. The other, because they're considered to be risk-free, the other way that you can do that is a reverse repo operation where you lend your cash as a pension fund in exchange of collateralized treasuries or T-bills, and therefore you will be having on a risk-free deposit on your asset side. The SOFR rate, which is not depicted on this chart, it's shown later on, it's also very closely tracking the OIS rate and the T-bills. Effectively, OIS, T-bills, and SOFR in the US represent the risk-free bucket. In Europe, the risk-free bucket is represented by OIS and by German government bonds. The difference there is pretty acute in Europe. OIS, again, is accessible only to European banks. If you are a European treasurer, a corporate treasurer, a pension fund manager, and you want a safe, risk-free overnight deposit, you can either buy German government bonds, paying quite a hefty premium though, to the market-implied ECB rate, or also here you can try and access reverse repo. The repo curve in Europe, unfortunately, it's not data available to everybody. From personal experience, I can tell you that the repo rate for German government bonds is also much lower than the ECB rate. We will explain why there is such a premium between safe collateral in Europe and safe collateral in the US. Coming back to the other rates at the front end, the extinct LIBOR or the Euribor, still existing in Europe, or corporate bond yields instead have a layer of credit risk in it. And that is why the rate here is higher than the OIS or the safe collateral, both for the Euribor, both for corporate bonds in Europe and in the US. So you can get a higher yield in those rates by taking additional risk. For instance, when it comes to Euribor, this will be the risk of a European bank lending for the next 3 months or 6 months to another European bank, unsecured, not collateralized, rather than just parking their money at the European Central Bank, or even better, just buying German government bonds. The risk that you take between unsecured bank lending and instead just depositing at ECB is reflected in Euribor rates generally being higher than market-implied ECB rates or than German government bonds. Now, the reason why I walked you through all these instruments is to make you understand that the front end is composed by many different players and many different instruments. And after all, not all represent the same thing. All these nuances are very important, and as we will see, all these players are very important when it comes to the plumbing. Banks have access to the central bank and therefore to risk-free OIS rates. All the other guys pension funds, asset managers, FX reserve managers, corporate treasuries, so on and so forth, they have to find ways in the front end to deposit their dollars and their euros either risk-free, and they can use the repo market or the AAA government bond market, or they can take more risk at the front end using credit instruments. By watching what happens between these rates, you can have a good understanding of what's happening at the plumbing level at the front end, whether there are plumbing issues or not. If we go further and have a look at some of the distinction between these rates, let me now walk you through the distinction between OIS in Europe, overnight index swaps, and Euribor. Now notice, LIBOR is extinct in the US, but this distinction that I will now draw and explain also worked in the past as an indicator of plumbing issues in the United States. Today, we will draw the example of Euribor and the European overnight index swap. So, let's have a look at this together. Remember, the Euribor is the rate at which European banks lend unsecured to each other. Therefore, they take the risk of default on each other. Euribor rates, therefore, are higher than OIS rates because OIS rates are simply reflecting deposit rate at the European Central Bank priced over time. What I did on this chart is I priced for you the difference between Euribor and OIS rate over a one-year tenor. So the orange line on the right-hand side shows one-year Euribor rate minus one-year Euro OIS rates. In other words, I am depicting 12 months tenor here, and basically this difference, plotted over time. It's in orange. So let's have a look at where this normally trades. Well, to take a normal period in Europe, you have to go past the 2013 recession. So if you have a look at what happened, for example, in 2014 or 2015, right about here, the average level for one-year Euribor rates was about 30 basis points higher than European OIS rate. That is again the credit risk premium that is priced in Euribor rates for banks taking the risk of unsecured lending to each other rather than just depositing at ECB. This rate trended lower and lower and lower and lower over time, as you can see, up until basically the zero area, a few basis points only, that was in 2021. And this happened as, over time, the European Central Bank expanded their balance sheet. The blue line on the left-hand side shows European Central Bank excess liquidity. Excess liquidity in the Eurozone is basically a proxy of the central bank balance sheet. So the European Central Bank between 2015 and 2022 did a lot of quantitative easing and also of TLTRO. So they did QE and they also did TLTROs. Now, both of these monetary operations add bank reserves to the system. In quantitative easing, you have the central bank creating bank reserves and purchasing bonds with these newly created bank reserves. The bank reserves end up in the banking system and generate what's called excess liquidity, excess money for banks, basically. TLTRO is a recent is a recent new monetary mechanic created by the European Central Bank, which basically is a loan. So the central bank would take collateral from European banks and lend reserves to them. So the central bank creates bank reserves and lends them to European bank in exchange for collateral. Again, European banks find themselves with excess bank reserves, with excess liquidity. The combination of these two operations led excess liquidity in the Eurozone from 2 trillion all the way up to almost 5 trillion euros. As a result, in the same time, apart from the 2020 blip of a couple of months where a lot of credit risk was priced back into markets, when excess liquidity rose and kept rising over time, also the spread between Euribor and OIS compressed aggressively. And why is that? The spread between Euribor and OIS tends to spike in case of funding stress or credit stress in the banking sector. It's one of the measures of plumbing issues in banking. If excess liquidity is rising, and it's very, very, very large, several $1 trillion of excess reserves in the system, that means that banks will tend to lend these reserves to each other much more freely because there is a great abundance of them, which means the Euribor rates will compress over time. And that's exactly what happened between 2015 and 2021. A rise in excess bank reserves led to banks being more happy, more free to lend reserves to each other, and therefore the rate required, the credit spread required for banks to be willing to lend to each other was lower and lower because of the excess bank reserves. The opposite tends to happen when we have situations of either tight money, tight amount of bank reserves, but most importantly, when we have credit or funding stress in the banking sector. Let's have a look at the episodes where Euribor versus OIS spiked dramatically. So that's 2008 in Europe, and that's 2011, 2012. The spread between Euribor and OIS in Europe rose over 100 basis points, so it more than tripled for its let's say from its normal average level, from 30 basis points all the way to 120, even 160 at the peak of the great financial crisis. That happened for two reasons. The most important one is that credit stress and funding stress in the banking system was abundant, and therefore monetary plumbing wasn't really working because banks weren't happy to lend money unsecured to each other due to rising default risks. Following the spread between Euribor and OIS is an important indicator of plumbing risks and stress in the market. The second reason was that excess liquidity was basically non-existent. So the European Central Bank hadn't launched QE, and even done any outright monetary operations to try and inject excess reserves and excess liquidity into the system. The combination of the two, but most importantly, the credit stress, the plumbing stress in the system, led to the spread between Euribor and OIS to spike aggressively. If you were trying back then to extrapolate market expectation for risk-free rates by looking at Euribor, you were making a major mistake, because you were looking at a rate that reflected a lot of credit, funding, and plumbing risk in the system, rather than just reflecting risk-free rates, which is in the end what you're interested here mostly. So again, you follow OIS, both in Europe and in the US, or SOFR, as we will discuss in the US, if you want to understand pricing for risk-free rates over time. You can instead follow Euribor against OIS to get an idea of whether the monetary plumbing is working well or not. Now, said that, we now need to talk about the more subtle difference, because so far we identified a difference which was relatively clear, which is the difference between a credit embedded rate, so LIBOR or Euribor. It has a credit spread component due to the unsecured banking lending risk and the risk-free rate. But what about the difference between the risk-free rates themselves? What about the difference between OIS, German government bonds or treasury bills, and even SOFR or repo rates that we mentioned being important, particularly in the US? Those differences, as you can see here, they're more subtle. In Europe, they're pretty wide, but they're also important to track and follow for the monetary plumbing. So let's talk about risk-free markets. And in particular, let's talk about OIS and government bonds. What is the difference? Why does it exist? We'll take again the case of Europe, because the difference is more marked between Euro overnight index swaps and German government bond yields to explain the dynamics and the subtle differences between these two rates. So here is a zoom in. You can see that the difference between German government bond yields and Euro overnight index swaps is somewhere like 30, 40 basis points, a meaningful difference for short-dated instruments. Here, on the right-hand chart, you can see something called asset swap spread. As I said, bond markets is full of jargon, but the reality is pretty simple. What I've depicted here, this so-called asset swap spread, is nothing else than German government bond yields minus the equivalent tenor overnight index swap, or basically the ECB rate proxy over time. As you can see, this number is always below zero, the whole time below zero. That's the first thing we need to explain. To explain why German government bonds over time since 2005 always trade at a discount against ECB, at a premium when it comes to yields, so they yield less than the equivalent European ECB rate proxy. To explain that, we need to go back to the players. And so in Europe, if you're a bank, you have access to the ECB deposit rate. But if you are a pension fund and asset manager, if you are China accumulating euro FX reserves, if you're a corporate treasuries with a lot of euro proceeds from your sales in Europe, and you're looking for a safe way to park your cash, you don't have access to the ECB, you have to buy safe collateral. The safe collateral in Europe is very, very scarce. Scarcity of high-quality AAA safe bonds is what drives this premium over time. To make you understand the level of scarcity in Europe, the only AAA liquid bond market is basically only the German market. The Dutch market, but it's pretty small, and then we have the European Union bond market, which is just newly born and didn't even exist for most of this time period. So when you have such a large and open economy, with so many foreign entities having euro deposits that come from selling goods and services and products towards the European market, when you have such a vast amount of euros to be deployed in safe risk-free instruments, and so little AAA safe collateral available, basically only the German market, the obvious result is that the German government bond yields will have to trade at a premium against euro overnight index swaps, so ECB rate proxy. Effectively, there is a scarcity of high-quality AAA safe bonds and an abundance of demand for them from all these institutions we discussed that are looking for safe collateral, pension funds, asset managers, FX reserve managers, but they cannot deposit money at the European Central Bank. This explains the big difference, structural big difference between German government bond yields and European overnight index swaps. If we go back to the US, you can see the difference is much less. Most of it's because the treasury market is really large and it can accommodate much more structural demand for US safe deposits, safe instruments, T-bills. The demand is extremely large in the US, but the supply of safe collateral, due to US debt being much higher, due to US deficits being continuously negative, which means the government has to issue bonds to accommodate these deficits, basically there is an abundance of T-bills to generally meet the demand for US safe bonds. You can't say the same for Germany. And that's why you have this vast difference. When it comes to the monetary plumbing, though, the rate of change of this difference is very important, and it gives important signals, both in the US and in Europe, when it comes to maybe something not working properly in the plumbing area. So the difference between T-bills and OIS, or the difference between German government bond yields and OIS, is an important indicator to track. It's called asset swap spread in jargon. Now let's have a look at when the periods of stress happen. So when you have German government bond yields moving much below the level of ECB rates priced by markets, you know that something is happening, as in people are demanding safer and safer collateral in a more and more aggressive way than they were before. And you can see how this works. In 2008, 2009, the premium, so basically German government bond yields 2-year, were yielding over 100 basis points less than the equivalent ECB deposit for the next 2 years. So basically all these pension funds, asset managers, FX reserve managers were demanding to get German AAA collateral in a very, very aggressive way. They were taking away all their short-term corporate bonds, maybe they purchased French bonds or Italian bonds. They were all going into Germany at the same time. The supply of German government bonds can never respond to such rapid demand in case of stress. So getting an idea and tracking the difference in yields between German government bonds and 2-year Euro OIS yields is really, really relevant. Now, you're listening to a lot of relatively technical and apparently impossible to get data series. We are gonna cover where to get this series. As the Macro Compass client, a lot of it is available live for you on the Volatility Adjusted Market dashboard. As a Bloomberg user, so what are the codes and how to find and how to track all these indicators, and as a client that wants to get this data from free public sources as much as they're available. All of this will be covered in separate slides, so stay tuned there. Now, coming back to German asset swap spreads, you can see that 2008 or periods like 2012, again, the European debt crisis, you have spikes, and those spikes are pretty strong, and they are something to follow when it comes to understanding whether there is plumbing stress, credit stress in the front end of the Euro market. But also, this works exactly the same when it comes to T-bills against OIS in the US. Finally, when it comes to markets and instruments at the front end, we have covered OIS, we have covered safe collateral, we have discussed about the credit component embedded in Euribor, we have discussed why it is important to track the spread between credit and safe, so Euribor and OIS, for example. We have even discussed the nuances between safe collateral and OIS, so T-bills versus OIS or German government bond yields versus OIS. It's now time to have a quick chat about the repo market or SOFR in the US. So, repo and reverse repo are important markets for the front end. And this would require a separate course altogether, but I want to walk you through the basics at least. So, the first thing that we need to remember is that the repo market exists so that entities can exchange cash for safe collateral and vice versa. So basically the repo market makes it so that an entity with cash to lend can meet an entity with a safe security, often a treasury, that wants to lend this treasury in exchange of cash. Now, remember, why would people actually be on the cash lending side? Those are the very same guys that have no access to the central bank, pension fund, asset managers, etc., etc. They are looking for a way to turn their cash into a safer form of overnight deposit. Why is this not safe? Because cash for a pension fund or for an asset manager, etc., that cash is an unsecured bank deposit. PIMCO has cash overnight deposited at JP Morgan. This is an unsecured loan to JP Morgan, as we have seen during the March banking crisis. In most cases, if you have banking stress, your unsecured cash is at risk. All institutions without an access to a risk-free deposit rate like a deposit at the Federal Reserve will be looking for ways to lend their cash in the repo market in exchange for a collateralized security. So they want to make a collateralized loan. They want to lend their cash and they want that loan to be collateralized by a security. This security is often a safe treasury, a safe bond, a safe government bond. After the repo transaction, indeed, you will see that the cash lender has exchanged their cash for a repo operation, which is a loan securitized by the security, and the cash borrower has extended its balance sheet by basically lending the security and receiving the cash. This guy, the cash lender, the pension fund, the asset manager, has engaged in what is called a reverse repo transaction. So basically, this direction is a repo and this direction is a reverse repo. Again, it's all about jargon, but it's really easy if you understand the mechanics. And the entity that so far had an unsecured deposit at a bank now all of a sudden has a secured, collateralized transaction, collateralized with a safe collateral. This is most likely a T-bill or a AAA rated government bond, and therefore they are now lending their money collateralized by safe treasuries rather than having an unsecured bank deposit. Now, the repo market is especially important. Well, it's important in every jurisdiction, but in the US, you even have a way to track where the repo market is trading, and that is SOFR. SOFR is a newly created rate that, to make the story very simple, tracks very closely the prevailing repo rates in the United States. So the rates at which these transactions are agreed are tracked through the SOFR. As you can see, SOFR rates are very, very closely resembling Fed funds rates. Why? Because you have a really risk-free collateralized rate, collateralized with treasuries. That lending is effectively very, very similarly priced as simply depositing money at the Fed itself, which is Fed Fund Term Structure, which is OIS. In plumbing, if you see big differences happening between repo rates, SOFR, that you can track, and we will show you where you can track it, and OIS and T-bills, you need to start wondering what's going on at a plumbing level, because something is breaking in a very important market, the repo market, that is used broadly by entities without an access to the central bank to generate a safe form of deposit. Now, time to recap what we learned in the first part of this lesson. So guys, what we have learned so far is that there is not only one front-end instrument, one front-end interest rate, but many. And you should learn to distinguish between them and what they represent. So, we have seen that there are basically two layers of the front-end instruments. There is a bunch of risk-free instruments. Those are repo rates, those are the OIS, overnight index swap rate, and AAA safe treasury bond deals or German government bond deals when it comes to Europe, for example. Then there is a second battery of rates that represent an additional layer of complexity. Those are the extinct LIBOR or the existing EURIBOR in Europe, because they represent unsecured banking lending rates. So those are rates at which banks lend to each other and therefore take risk on each other, default risk on each other. Or other credit embedded rate, for instance, corporate bond deals. Or if you move to Europe, you might argue Italian government bond deals, which have a certain layer of credit risk embedded into those. Those are the two main categories. And we have also learned that looking at overnight index swaps, that is the purest representation of risk-free rates you can get, because overnight index swaps are nothing else than the market representation of the future path for central bank deposit rate. And a deposit at the central bank is the safest form of short-term interest rate you have in the world. Closest proxies to OIS, like SOFR or repo rates, are also an important indicator to track, and treasury bond deals, so T-bills and German government bonds, as we have seen, can have quite some nuanced differences between OIS rates, especially in Europe when there is scarcity of AAA collateral. The spreads that we have checked, so the differences between all these front-end instruments, especially the difference between treasuries and OIS, German government bonds and OIS, which we have deep dive in, or the spread between EURIBOR and OIS, which we have also had a look at, include and explain different levels of complexities and monetary plumbing. So if you're looking at treasury rates even, or you're looking at EURIBOR rates, rather than focusing on OIS rates, what you are doing is you're adding a level of complexity. The rates you want to focus on when analyzing the front end are OIS rates. Those are the purest form of market expectation for central bank rates. Looking at other rates like treasuries or EURIBOR, for example, add a layer of complexity, but you can use these rates, and especially the differences between treasury yields and OIS, German government bond yields and OIS, EURIBOR and OIS, as important indication of a well-functioning monetary plumbing situation or whether there are monetary plumbing issues.